Well, the streak was in jeopardy for most of the day today until the very, very end of the day. We had one late last push higher to get the markets to close on a winning note. It was barely a winning note, but we achieved 13 straight Mondays in a row with a gain on the S&P 500. That was not the case on other indexes. So we're going to break down and again, it's even as bullish as we were on the S&P, it was the weakest Monday out of all 13. So not necessarily lucky number 13 as we might have thought it was. So I'm going to break down today's action, kind of why we were bearish as we were in some areas, and not so bearish, and actually pretty bullish in other, a lot more bullish than what you'd expect in some other areas. So we're going to break down that divergence and just what do we expect? Like, which of these indexes do we expect to lead us and why? So we're going to break that down in today's video, taking a look at the sector rotation, some fascinating moves, especially in those interest rate sensitive areas, developing some oversold clusters in some of those areas as well. Very significantly bearish charts, but not, some semi-bullish charts and others. So, we'll take a look at that, break it all down like we always do, give you where I think we're going to be headed and why, and whether that's actually changed with today's move. Has this divergence changed our expectations of what we've had for the last little bit? So, in our trade idea is a stock that's what has been a very strong sector has really shown some weakness here lately. So we're going to take advantage of that weakness and talk about how to trade it. So let's go ahead and get started. Today is Monday, October the 2nd, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video that I do every day at 3:30 Eastern Time that I do the Market Outlook videos. Come down to the bottom, click this heart. It opens up this tab. Click that like button there. Same thing here. Click on this thumbs up icon. It takes you to that tab. Hit that like button there. Again, the more you do that, it really helps us out a lot by getting our content out to all of our followers on those platforms. We got up to 95, so that's how close we got to 100 this go around. It's a big jump up from from last Wednesday's video. So thank you all very much for the likes here. Again, the goal is 100. Every time our goal is 100. So those who are liking these day in and day out, thank you. Those who aren't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. So late rally here, as I mentioned before, got us up to a close. We were 0.3% higher, 0.3% higher today by the end of the day. We're still dark pink shading in a red line. The near-term line has dropped back down. It's not back in the reversal zone, and as of right now, there's a pretty good chance that it probably won't get in the reversal zone because the momentum line kind of rallied up here as the S&P moved off of the low of the day. So that's actually a pretty decent sign. If we can, yes, this is a bearish near-term peak. It's about as bearish as you can have. But if we can follow that up with kind of a bullish near-term low, so a low that doesn't get in the reversal zone, that would be a very, very good sign for the markets here in the short term. We'll see, right? More than likely, again, it's hard to follow up a bearish near-term peak like this, especially when you're in a bearish market with a quick bullish move like that. So it's unlikely. You can get something like that, as you can see, when you're in a bullish market, when it's a little bit easier and you're starting to get mature and the near-term line has a hard time getting going, but you're not really too bearish. The momentum line actually did get in the reversal zone there. So there is it is more likely to occur when the market's got more of a bullish posture, obviously, than a bearish one, especially when you are, again, more than 2.5% below, nearly 3% below the moving average. And we're clearly in an intermediate trend to the downside right now on the S&P 500 during this particular exploration cycle, which you can see so far has been relatively bearish. Let's take a look. The NASDAQ is the one that held up the best today. It was up almost a full percentage point. The mega cap names acting as a safe haven trade. It actually turned the moving average up, which, even though we're not above it, we're not below it enough to keep it down very strongly, and the moving average turned up. That's why it's yellow. We're below a rising moving average. Your moving average on this chart turns yellow when you're either below a rising moving average or above a falling moving average. In this case, we're below a rising moving average. So, but your near-term line, while it's still in bullish territory, is not in the upper reversal zone. And again, unlikely to get there. Doesn't mean it can't. Nothing's 100% or 0% in technical analysis. So, doesn't mean it can't get there, but it's unlikely. The odds are lower because the momentum line didn't get there. And the momentum line's already down in bullish territory. But your intermediate line is rising. It's almost out of the reversal zone, avoided a cluster. So that's a good sign. On the other hand, the Russell 2000 got hammered today, down a full percent, a 1.5%. Again, very bearish near-term peak. That obviously played out to more of a bearish move than what we saw in the S&P. The intermediate line still easily in the reversal zone. It actually turned back down, still below the 10th percentile. I mean, you're about as bearish as you can be, which is again, it's kind of hard for the markets to be strongly bullish when the Russell 2000 is getting just absolutely hammered. Your Dow Jones Industrial Average also finished slightly lower after a pretty big day on an intraday basis on Friday, gapping up and then falling throughout the day again, forming a bearish near-term peak. Near-term line's already in bearish territory again, not in the reversal zone, and the momentum line again kind of only stayed down there for just a little bit of time. So it was this, like I said before, the streak on the S&P got to 13. This is the smallest, right? This one was the smallest. We were only up just barely on that day. This is even smaller than that. I mean, we are 1/100th of a percentage point up. I mean, that's about as small of a gain as you could possibly get. I think we were up, 44.50. We were up more than 3 points. And remember, today we're up 10. That's 10 times more than what we're up today. So this is by far the smallest Monday, and it only turned positive because of that late move. But it's 13 weeks in a row, again, the last couple of weeks have been bearish following that slight up Monday. So we'll see how things play out for the rest of the week. You would assume, again, as easy as it is to say, hey, we're going to be up on Monday because that's 13 weeks in a row. That's kind of the trend right now. It's almost just as easy to say we're going to be, there's going to be a heavy weight on the markets the rest of the week because that's been the pattern, right? That's been the recent pattern here. Looking at the weekly candle that we started off with here, it's a pretty bearish candle, not as bearish as a smaller body. So it's not as bearish as it was, but it is a lower close so far. It's a higher low. Remember, that's kind of the first sign that things can turn around is when, even though you get a lower close, you get a higher low. So we'll keep our eyes on that for the rest of the week. There's still 4 more days left, so it's not, the weekly chart's not done. That PPO is falling pretty sharply. That's a pretty clear bearish PPO on the S&P. The Russell 2000, remember, actually has a death cross now. We're a full percentage point down. So death cross environment there, and again, we are getting a lower low and a lower close on the Russell, and they're pretty decent. And again, smaller body. And it's above its moving average, so we'll kind of keep an eye on the size of that body and whether that's another sign of weakness, for example, on this trending move. Is when you start to get back above the moving average, you can see that tends to lead to, like it says, like it did here, like it did over here, it tends to lead to a new move back, even though you can see, even though we had a lower close and a lower low there, and the PPO was falling, but the candle, the size of the candle was smaller, the size of the body was smaller, got above its moving average, and we started to work our way higher. So we'll see if that ends up being the case this go around. This is not the biggest decline, like as we've talked about before. If we're actually indeed in a, if we are indeed in a correction, as you can see back to the beginning of 2022, if I put my cursor at the lowest point of these bodies, you can see when we are actually in a correction, as we were at the very end of 21 and the beginning of 2022, the lows get a lot bigger than this. So that's why I'm not too hyped about this crossover yet, because I'm not really sure that it will actually maintain itself before we get a little bit lower to the downside. You can see something like this where we again, we're not done with this week, so the body can get bigger depending upon if we are more bearish throughout the rest of the week. Let's look at the 3 green arrow chart. You can see, again, 3 red arrows across the board, even though the moving average is rising on the Qs. It's the only one that it is. But everything else has got 3 red arrows in that red line. So the MACD was closest to getting a green arrow in IWM, but that turned around to some new momentum. Right now, the Qs is the closest one to getting a green arrow, especially if we get a move back above that moving average. You get a green arrow and a green line. Your stochastics is also pretty close to getting a green arrow on the Qs. So you're actually pretty close to 3 greens on the Qs right now, which would be a fascinating turn, right? That would be a significant change in sentiment, turn in direction for these indexes. In fact, if you look at the Qs on this chart, we're not above the 17-day yet. And obviously, if you're going to get above 30 and get that 3rd green arrow, you got to get above the 17 first, which would also be a major Fibonacci level if we do. MACD is almost positive, as we mentioned. Not the case on the spiders. The spiders are nowhere near the 17-day. The MACD is also not above its moving average yet either. That's when you get that green arrow. IWM was also pretty close to getting the green arrow, but now the MACD turned back away from its moving average with some strong volume today, which we hadn't seen yet. Remember, usually at the end of these moves is when you start to see these above average volumes, like when you get to the end of these declines. That's not the case yet. So it is today on IWM, though. Pretty significant move, pretty big range relative to the average as well. And you're flirting with dropping below the point of control, which seems odd because, like if you look at the other indexes, spiders are nowhere near its point of control, way down here. QQQ is also nowhere near its point of control, way down here below the 200-day. But IWM is below its 200-day, clearly below the 17 and the 8-day. And still re-engaging some as the 30 days about to cross the 200. So we've got some clear momentum to the downside there. Looking at some of these other oscillators, you're still in bearish mode on the S&P, and you're obviously clearly in bearish with the ADX rising above 20. You're clearly in bearish mode on IWM with this ADX above 30. I mean, that's a strong bearish trend, very, very strong bearish trend on IWM. The Ichimoku cloud, again, we're bearish, we're below the cloud, we're at the pink portion of the cloud. We're not above it. Again, goes to show we're more in correction mode right now than just pullback, as that pullback bounce failed there. There's the rate of change is clearly negative. We have at least an intermediate trend strength going on. IWM is that close to a mature bearish trend, which again we haven't had for a while since the banking issues. This has been a lot. That was a pretty quick decline, and then we based. This has not been a quick decline. It's been a much longer. We're way below the cloud, and the cloud's actually a pretty decent size when you look at the depth of that cloud there, which again doesn't get that big when you are in bullish mode. The Qs, however, again you can see. I mean, we do have an intermediate trend strength going on the decline. You do barely have a negative rate of change. Might be actually slightly positive, but we are below the cloud. The green line's below the blue line. We're below the cloud by the time, at the time it's turning pink. So even though it's not down very much, it's also has signs of correction too. So it's just holding up pretty well because the mega cap names, which make up 50% of this index, the 7 mega cap names are holding up better. They're acting as a safe haven trade. With utilities getting beat up as much as it is. Of course, the RSI, CCI are still at bearish levels. The weekly CCI is still below minus 100, so we're clearly in correction mode there. We did get below minus 100 on the NDX as well, even though we're back above it. We're still, we have triggered that the correction level type move there. Of course, the Russell is obviously down there. In fact, its weekly RSI is about to drop below 40. It goes to show just how bearish this index is. You can see clearly below 40 on the daily, and obviously well below zero. So nothing bullish at all on these indicators. Let's see here. Looking at the Keltner channels, let's take a look at the Keltner channel. The bandwidth still rising in the S&P. You are still right there at the lowest quartile. And you were, for the most part, below the Keltner channel for most of the day. It was that late rally got you barely above it by the end of the day. We'll see how that goes. The momentum is still clearly bearish to the downside. Hasn't turned up yet, and you got the green dots. IWM is the same, showing the kind of a similar pattern, still in the lowest quartile, still below its Keltner channel. The momentum is actually weakening on that, but it's still bearish. So we're kind of keep our eyes on when this gets above its Keltner channel for good, and then when it gets, in the upper, gets out of the lowest quartile, and especially gets in the upper half, would be ideal for a turnaround in this index. The other thing you look for a turnaround, which we got half of it today on the Arun indicator, is to get the green line to zero, and you notice it's dropped down to zero. Now the high has moved way over here, so it's not jumping back above 100 yet. And but the nice thing is we haven't had a low for a few days. You need to avoid getting a new 4-week low for at least 6 days, which gets this red line, below 70. That opens you up for the spike to 100 on the green line, which is generally a good sign that we're starting a new intermediate run to the upside. So at least we got to zero, right? At least this got to zero. You got to the furthest day, and then now, and that's, you only need it once, so it doesn't need to stay there. And as long as over this week, if we can avoid getting if this can be the higher low point and we can finish the week with a higher high point, that would be outstanding. That would be absolutely outstanding. Then we would set up really well for a new 4-week high point, probably the week after that. More than likely, this is probably going to be more like it has been recently, the high of the week. It has generally occurred on Mondays, and we're probably due for a new lower low point by the end of the week. That's my expectation, given the past precedent here and the fact that nothing's really changed trending-wise to alter that trend that we're seeing. Today's range in volume were really small. The range was below average. The volume was barely above average, but it's the smallest volume of the past week. So that's not surprising on a Monday. I mean, last Monday's was really small volume and a relatively smaller range. So we'll see how that plays out. Obviously, that wasn't the case for IWM. IWM had, the highest volume of the past week and a above average range. So it was just the S&P that was really quiet, and I don't think it will stay quiet through the rest of the week here. The VIX is not above 20 yet, but it's up there, and it's still above this 95% mark relative to the VIX 3M. The VVIX is still relatively muted, so that's why we're not getting a big move on the VIX, because the VVIX is really staying down. There's not a lot of expectation right now for the VIX to rise up very much, which is fascinating. And that we're not seeing that, and so that's keeping the VVIX is keeping kind of this idea of the VIX going up very much. The VIX was above its 200-day moving average again, but still not above 20, which again, most intermediate declines gets the VIX above 20 and above its 200-day moving average, and we haven't seen either. We haven't seen the VIX get above that 100% mark, much less the 105% mark, which is normal against VXV, and of course the VVIX was only above 100 briefly. Generally gets a lot higher than that during intermediate decline. So we still haven't seen the volatility, even though the decline has been pretty significant. I mean, it's still smaller, right? It's still smaller at 6.87% than the last two intermediate declines. So it's still a much smaller move, though, when you look at, as I mentioned before, see, now we're at a 44-day rate of change. Even though the actual decline is much smaller than a typical correction low point. And again, the volatility is much lower than what you expect in a typical correction low point. The rate of change since the highest close is much lower than what we saw there, the last two intermediate declines. That's very typical for an intermediate decline, just like we saw in 2021. It's very typical for it to come down and then bounce back up within the amount of time that we're in right now. That's not the case here. This is more typical, again, of the market being in correction mode. All right, now let's take a look at what's driving a lot of this price action here today. So let's move over to our asset class comparison chart and just look at today alone. And you saw, or at least probably heard, Yields were a big mover today. So let me bring this up. Just today's comparison, you can see the big move in yields to the downside. Of course, the safety trade of the Qs, as you'll see here in a second with the sector rotation, actually kept it pretty positive. But look at the strong dollar. Strong dollar, strong yields, weaker commodities, but at least that combination of higher yields and higher dollar has been bearish for equities. And like I said, it was very bearish for IWM and developed markets for that matter. Emerging markets, incidentally, did not fare that negatively relative to U.S. equities, considering how strong the dollar was. But still, these are strong moves in some of these asset classes. You can see the dollar up 7% off of this low point. How far up can it go? You can see some of these other green boxes. This is with a 10% zigzag. So it can make it. We had a typical decline on the dollar here, and now you can kind of see how far up some of these runs can be. And we're only up 7%, and you can see the weekly candles this would be another weekly gain, especially on the Hakinyashi. It'd be another higher Hakinyashi close and another higher high. Like we have had one week of lower highs, the rest have been higher highs, but this is another higher high, and it's easily another higher close so far in the week. So the dollar's clearly in bullish mode. You can kind of get an idea. We may only be halfway there compared to some of these other numbers that we've seen. Of course, TLT has been down. It's down 20% since its last peak, last 10% move, which was this 16.5% rally there. So from that peak, we're down 20%. That's a pretty big decline, as you can see. Obviously, its Hakinyashi candle is pretty clearly lower as well. When you look at here, let me pull up this chart here. When you look at this chart again, we're kind of flirting with. I go all the way back to it in its history. We're kind of flirting with these lows, and maybe even just a little bit lower as we get a divergent low point forming, a pretty significant divergent, because we're pretty easily below that 91.80 level down to 86. So this isn't just a kind of slightly lower low. It's a pretty significant lower low. Obviously, it's still a higher low on the oscillator there, in this case the MACD, that kind of long-term MACD, weekly MACD. So the dollar and bond yields, continuing to make their way back up to the upside. We hit 4.7% earlier today. That was kind of the magic number that put a lot of pressure on equities. You can kind of get an idea of just how far. You have to go back to 2007 when the correction started. That's about how high we got. We were even before 06 and 07. This is a pretty high level. You go back to the end of the bear market in 2000. We got up a little bit higher, up towards almost 7%. And there's some calls for some people saying that we'll get back up to 7% again. That's not out of the realm of possibility at all, especially considering where the Fed funds rate is and the typical spread between the 10-year yield and the Fed funds rate. As obviously it's still inverted, but it's looking to uninvert with the 10-year yield rising rather than the Fed funds declining, which is your typical route for that yield curve to uninvert. So significant moves in those areas. It's interesting to see the sector comparison chart today, as energy, which has been such a strong mover, really lagged behind, and so has utilities. So energy and utilities, again, are the weakest areas of the market. Real estate as well, it's not surprising, REITs at least. And look at your big winners, XLK, XLC, XLY. They were all big winners. Industrials, financials, materials, all lagging behind the broader market. Staples didn't do so bad. It underperformed, but it still beat some of these other cyclical areas. So did healthcare. So when you look at the sector, the 12 grid for the different sectors, you can see again these three up across the top. Even though you have dark pink shading here, you have light green shading because you're above 20 on the intermediate line for XLC. But you're clearly dark pink shading and a red line everywhere else. Getting a cluster on utilities, again, the third cluster in a row. That's a pretty significant move, which is all related to what's going on with yields. I mean, you're down 15% over 3 months. I mean, that's the kind of move that you would get in XLK with XLU being down 4.5%. That's a significant move. In real estate, down 12% over 3 months. You know, usually you'll see those kind of numbers in those areas when XLK, YC are down like 20% or 25% in that area. So for them to be up for XLC or down just a little bit for XLK, while these two are down double digits in 3 months, kind of goes to show, you know, that these magnificent 7 names are the new safety trade right now. At least they are the new safety trade, whereas utilities and real estate, both of them are showing dividend yields that are quite a bit less than what you're seeing on there's your dividend yield, 100 basis points less than what you're seeing on the 10-year yield. So it's making this not very attractive at all to one to own. And then you look at XLRE, and it's also more than 100 basis points less than what the 10-year yield is getting. So not the best trades. And when you look at their charts this by themselves, and let's go to more of a longer term view, this is again not something you typically see unless the rest of the market is just really, really bearish. But utilities is way below its 200-week moving average, like way below there. And real estate, you can see as well, is easily below its 200-week moving average. Not as dramatic in the past few weeks, but I mean those are bear market levels for both those interest rate sensitive areas, but traditionally safety trade areas. They're doing worse right now relative to the 200-week moving average than what you saw there in COVID. And of course, we were shut down in COVID. And when you look at the XLU then with COVID, XLK, was outperforming there too because it was a safety trade at the time, and it was still holding up better. And right now, it's not even like barely above the 200-week. It's actually still above the 300. Now it's still below the 17-week, so it's still showing weakness with the MACD bearish. But it's well above the 200-week. So there's still a sizable gap to fill in between the 30 and the 200-week moving averages there, which is what a correction is when you start to fill that in. S&P is already kind of flirting with filling that in, whereas the Russell is done that and more, right? The Russell 2000 has already clearly broken its 200-week moving average, and now you're 8 and 17. Your 8's crossed below, so your MACD is negative. And now your 8's crossed below the 30, right? And you're about to get the 17, and both crossing below the 30 and the 50 for that matter, easily below the 200-week moving average. All right, speaking of that weakness in energy, I did want to take a look for our trade of the day today at Valero. So let's take a look at that here really quick. Valero, you can see, got a bull tag today, finished below the moving average, was actually a lot more below it until this late little rally. But you notice, unlike the last bull tag, short-term sentiment's a lot more bearish this go around, and your intermediate line's a lot further below market sentiment this go around than it was the last time. So more likely than not, this is the bull tag that kind of starts intermediate declines, more so like these last two, more so than a bounce, right? Like we saw with these two at the beginning of this, during this intermediate rally up to the upside. Obviously, 0.5% is not that big of a deal. It is bigger than what we saw. It was only 0.11% there. The weekly chart is showing a reversal. All right, we got a transition candle last week. You're getting a bearish candle so far this week, closing as of right now kind of on par with that open that we had over there. So that's a pretty decent reversal sign. Again, the PPO is slightly rolling over, pretty significantly bearish candle there. So things are starting to look more bearish. Obviously, you have 3 red arrows today. 3 red arrows there. The volume wasn't too big. It ended up being about at average. Light push in volume here, and the range was above average as well. Again, much different scenario than last time when you had a smaller range there with that bull tag and slightly above average volume, but again, it was during a period of not very much volume at all, and now we've been starting to get more and more volume. So things are picking up and a lot more bearish this go around than it was this last time that we made the run down to the 30-day moving average. So again, trying to identify signs that this bull tag might turn out to be a reversal instead of the bounce like some of these others. You're not above 25, but you are well above 20 on the negative, and you're not below 25, sorry, on the positive, but you are well above 20 on the negative, a lot higher than the last time. The RSI and the CCI for VLO are relatively bearish. You are below the midpoint of the chart. We did not get below the midpoint that last go around. You're not only below minus 100 this time, where you weren't last time, but you're below minus 200. So another, again, sign that's likely, not, nothing is 100%, but it's likely that this will be a lot more bearish than the last bull tag. You can see the trend is a lot higher, and we haven't even, we broke the blue line a lot more than we did there. We're well below the green line because we were breaking both of them there. So we are, your cloud still hasn't closed. You haven't turned bearish yet. But I would venture to guess, considering how far below the blue line we are, barring a big move to the upside tomorrow, you're more than likely going to get this trend ending, which of course would also signal higher potential for a new intermediate decline to the downside. You can see as well on the Bollinger Bands and the Keltner channels, you're not in the lowest quartile yet, but you're definitely in the lower half of the bandwidth. And the bands themselves moved inside the Keltners as you're losing momentum, which usually means we're about to transition from positive to negative momentum. And then obviously that would mean more of a move into the lowest quartile, if not below the lower band, and pushing the bands back outside of the Keltner channel sooner rather than later. That would be the expectation on this. So what I decided to do on this trade is come over to the November contracts, because we're inside of 20 days now for October, and not be too aggressive with. So I didn't necessarily buy at the money. I went a little bit out of the money here. One strike is 5 strikes away, but it's just $5 away, but it's only 1 strike away. And then going to the 130. If you look at, the 119 is the contract, but you'd have to break the point of control. So I didn't want to be too aggressive on the downside, and that gives me about a 2-to-1 reward to risk ratio here. About $500 risk, a little bit more than that, and almost $1,000. So almost a 2-to-1 reward to risk ratio, and that's how much flexibility I have to work with in case it doesn't keep going down, right? If it starts to kind of hold up a little bit here for a few days, I've got that much time and flexibility to work with before the max gain gets outside of a 1 standard deviation window here. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.